So good afternoon, everybody. I'm sorry we're starting a little late, but Midtown traffic is what Midtown traffic is, so in New York, unfortunately. Welcome. My name is Trish Mosser. For those of you who don't know me, I am the director of the Initiative on Central Banking and Financial Policy here at Columbia School of International and Public Affairs. I'm very pleased to introduce this afternoon's speaker, Dr. Andreas Brombritt, who serves as a member of the executive board of the Deutsche Bundesbank. Prior to be appointing to the Bundesbank, he had a long distinguished career as an international banker with several of the very largest global financial companies. He was a part-time professor as well, as I recall. In his current position, he's responsible for the Bundesbank's banking and financial supervision areas, economic education, technical central bank cooperation, and risk. As such, he's very deeply involved in international policymaking and cooperative work. He is the Bundesbank's deputy for the IMF, hence the reason that he's on his way down to Washington today. We're happy that he stopped by. In addition, he is a representative on the supervisory board for the Euro Area Single Supervisory Mechanism. He also sits on the Basel Committee and on the board of directors of the BIS. I'm very pleased he stopped by today and to discuss current challenges in the Euro area. Andreas.
Good afternoon, everybody. Thank you, Professor Mosser, for introducing me. Sorry to be late. Germans don't like to be late. I hate to be late, but I was both stuck. First, I was stuck in traffic, then I was stuck in the elevator. So I'm right here. Great pleasure to be here. It's my third time I'm at Columbia University, first time at this institute. We always had good debates, so I'm hoping for some good questions and reasonable answers. And this is a very fine school, I don't need to tell you that, and I'm very proud for being invited. And it's also, I think, kind of a good occasion to cherish the transatlantic exchange of ideas. The transatlantic issues have always been at the forefront of my career, all my career, also in my private life. I think it's very important, especially in times like this, to think about the transatlantic exchange of ideas. I have always, I must say, benefited from a transatlantic exchange of ideas, and I'm sure I will also for the future. Now, I'll probably speak round about half an hour, a little bit less than that, and I would like to speak about the current challenges in the Euro area. I hope that a subject like that will be of interest to you from a transatlantic perspective. As a central banker who is responsible for bank supervision in Germany, you might have expected a focus on issues concerning banks, a focus on financial regulation. I'm afraid I must a little bit disappoint you in that respect. I only wish to speak very briefly about the banking sector, but I think we have bigger issues at hand. So I'll speak about the Euro area first and the challenges we're having, but I'm also like to reflect on current issues of protectionism and other issues which unfortunately right now have become back into fashion. Now, undeniably, the health of the banking sector and the health of the overall economy are mutually dependent. There is no healthy economy without a healthy banking sector and the other way around. In the Euro area, banks play a much, much larger role than they do here in the United States of America in financing the economy. For example, in Germany, 75% of the economy are bank-based and financed by loans. So the banks do have a much bigger role than the capital markets here in this country. And the banking sector in Europe indeed is facing quite a number of challenges. For example, in some, but not in all Euro area member states, banks have a high ratio of, you may have heard about that, non-performing loans. And this ultimately has the potential, I must say, to become problematic from a macroeconomic perspective for the Euro area, as institutions that have a high ratio of non-performing loans, a high NPL ratio, tend to be preoccupied in dealing with these. And if you have a lot of non-performing loans, you have less time, and you also, I see a banker somewhere over there, you have also less energy to spend on financing the economy. So to have non-performing loans is not something to look out for. Another challenge, as much a structural challenge as the non-performing loans, is the profitability of the Euro area banks. or rather the lack of profitability of the euro area banks, I must say. Now, while banks are markedly better capitalized today, not only in this country but also in Europe, much better capitalized than in the wake of the financial crisis, 2008 and after that, the rather low profitability in the euro area might hamper the resilience of our banking sector back home. Now, to be honest, these two challenges imply a lot of work ahead, not only for euro area banks, but also for their supervisors like myself. What I would like to assure you, not going into too much detail of this, is that the European Central Bank and its national partners, like the institution I'm representing, are fully committed to keep up with these challenges. And also banks and their managements are fully aware of the homework which still is laid upon them. And therefore, instead of talking to you about financial regulation, I would like to use the opportunity to comment on more fundamental issues, because there are other and better places and better people to speak about regulation. Now, whether it's Brexit or the French elections in 3 days' time, actually, these two issues, by the way, during my last 2 days, were the topics which most came up, Brexit and French elections. Now, this is showing that Europe is experiencing serious headwinds with regard to our most ambitious project, and our most ambitious project still is European integration, even after such a long time of having a single currency. Populism in Europe is not everywhere, but is at worrying levels, I must say, accompanied by a growing skepticism towards many forms of transnational cooperation, not least in the United States, I have to say, unfortunately. Now, one of the drivers of rising skepticism has certainly been the crisis in the euro area, which has been a crisis of confidence, and, of course, its negative economic impact it is having for the people in the euro area. Meanwhile, just to be noted, the euro area economy is in a much better shape than it was several years ago. Last year, euro area gross domestic product grew at 1.7%. Does not seem to be very large from a US perspective, but this is faster than potential GDP. I just may add, in Germany, trend growth is round about 1.25%, and if you grow consistently at 1.7%, you're outgrowing, of course, and you're closing the output gap. And our suggestion, or our expectation, our projections are for the euro area to grow by 1.6 or 1.7% this year, next year, and 2019. So we're having a reasonable growth over quite a long period of time, which is sustainable growth, as I would call it. And this has had positive effects on employment. Unemployment in the euro area is still much higher than in the United States of America, but it's also higher than before the crisis. But it is also at the lowest level since 2009, just to be aware. The average unemployment rate currently stands at 9.5% in the euro area. In Germany, I could add that it's a lot lower than 9.5%. But this evidently does not provide the full story when it comes to the state of the euro area, because the challenges in Europe, they are rather complex. As H.L. Mencken, an American journalist with German roots, as you may be able to tell from his name, once said, and I quote him, "To every complex problem, there's an answer that is simple, clear, and wrong." Now, in line with that, I would like to take a closer look at the two major issues of the euro area and of the European project, namely, first, the quest for a suitable institutional framework in the euro area, and second, the question as to whether the cooperative framework underpinning the European project and the international arrangements is outdated, or whether we are still in fashion with what we are doing and what we have set up. The institutional arrangements of the euro area actually remain the key challenge. The euro area crisis in particular revealed severe structural flaws, I have to say. Let me just very, very briefly summarize the key lessons learned to give you a better understanding of the current reform challenges. Now, the crisis in the euro area actually demonstrated how much the euro area requires a framework that is able to absorb shocks and which is able to deal with heterogeneous issues across regions and across member states, because clearly the economic environment in the euro area is pretty fragmented. A key part of this challenge is that member states tend to be exposed to divergent regional developments, as the United States of America, of course, is also not uniform, while at the same time, the single currency in the euro area makes currency appreciation or currency depreciation no longer available as an economic policy tool. So what we have in the euro area, as you most likely are aware, we have a centralized monetary policy and we have decentralized fiscal policies, which of course you don't have, and that is a key challenge. And that's in an environment like that where currency appreciations or currency depreciations are no longer available, poses a structural framework challenge. Now, principally, member states may address their regional issues by employing independent fiscal and economic policies. Now, in a currency union, like in the euro area, the burden of excessive debt can be partially shifted from one member state to another member state, and this increases the incentive for member states to actually avoid politically difficult decisions in the short term by borrowing more, because they spread this debt across other member states who take up responsibility for those. Now, it's important to remember that this problem had been foreseen at the very outset of when the euro area was founded. The founding fathers of the European Monetary Union, they did put, actually, sometimes this is forgotten now, they did put rules in place to prevent negative spillovers, because obviously the founding fathers of the European Monetary Union saw this imbalance between a centralized monetary policy and decentralized fiscal policies. However, in practice, let me be diplomatic, the rules have not always been followed, not least because of the short-term incentives that I've just mentioned, that you are able to spread debt across regions and across member states. Now, the current challenge is not only about solving this institutional imbalance, but also about achieving this in a politically, economically, and socially feasible manner, which is kind of difficult given the high fragmentation in the euro area. In other words, and to put it a little bit less academic, Europe is struggling between the following dilemma, between easing short-term pain on the one side and committing to long-term reforms on the other side. And this is actually a dilemma which you need to solve in order to correct the framework. So let me give you a brief idea of the two options for the long-term reforms we need. Now, in both cases of these two options, a stable long-term solution for Europe can only be achieved if actions can once again be reconciled with responsibility for their consequences. If you live in a world, an economic world, where you don't have to take responsibility for your consequences, I don't need to tell you how incentives go wrong in that part. Now, the first option of the two options which we have in principle to solve these imbalances would be a very, very bold institutional step forward. This would actually shift responsibility for fiscal and economic policy to the supranational level, i.e. to the European level. If you have a European level responsible for monetary policy and you do have national fiscal policies, of course you can elevate a fiscal policy to the European level in order to sort of get rid of the imbalance between these two. That is, of course, option number one. In other words, what I'm saying is that would create a fiscal union, something the United States, of course, have, and the euro area does not have. A fiscal union would undoubtedly be the largest step in European integration since the launch of the common currency, since the launch of the euro. To go from what we have now to a fiscal union would be a huge, very, very massive step. However, it would mean that member states would transfer sovereignty from themselves to others, and they would actually transfer sovereignty to the European level and would give up sovereignty in that respect. And that would prove impossible without extensive amendments of the European treaties, and it would actually also make necessary, I would think, referendums all across Europe. In each and every country, you would have to hold a referendum. Now, appointing a European finance minister, for example, or establishing a joint Ministry of Finance, a joint treasury, so to say, would be two possible ways of enshrining fiscal control at the European level. So this is not at all impossible. It is practically possible. Admittedly, however, if you ever tend to go to Europe, there is currently very little interest and also very little prospect of finding political support for a fiscal union. If you tour the capital of the 19 member states of the euro area, you will find nobody who is really interested in transferring sovereignty from them to the European level. So this is an option, but you have to say how credible is the option in practice. Now, the second option would be to eliminate the flaws and to eliminate the inconsistencies of the current framework, to sort of learn from what we have seen in the crisis and so try to correct this. And this would imply a restoration of the core principles of national responsibility, which is at the core of the treaties in Europe, that at the end, each nation and each member state is responsible for its own fiscal policy, which is, by the way, what we have right now as the rule of law. What this means, above all, is that the repercussions of national decisions on national decisions on economic and fiscal policy must no longer be capable of jeopardizing the financial stability in the euro area as a whole. That is what we are talking about. Experience has shown us the need to focus on a set of very, very credible policy rules in the euro area. In other words, we need to think about rules that do not provide governments with incentives to flout them, which we do have right now, as we learned in the last crisis. And equally important, rules need to fit together, creating a consistent incentive structure. Only if there is a consistent incentive structure, these set of rules could actually work. And I would like to demonstrate this reasoning with respect to the so-called sovereign bank nexus, which is something we have in Europe as the prime example of this nexus. So what do I mean by sovereign bank nexus? This is an unhealthy relationship between countries and their banks, something which we experienced in the last crisis, whereby banks land on a large scale and without a capital charge to their home countries. So according to the Basel rules, if you buy a sovereign bond or you lend to sovereigns, you don't need to put a single dollar or euro of equity against this, nowhere in the world. So that is the rule. Now, governments simultaneously find they must support struggling banks in order to prevent an immediate crisis. So we have had situations in Europe where countries like Spain and Ireland had banking systems which were very, very exposed to the real estate sector. The countries themselves, both Spain and Ireland, not having very high debt burdens, but found themselves in need to rescue the banks. We have other countries where banks were very strong, but the governments had a high debt load, and actually, you have a contagion effect both from the banks to the sovereign and vice versa. This bank sovereign nexus is especially large in Europe. Now, this nexus still persists, by the way, in many euro areas as I speak, and is an important impediment to a credible no bailout clause. And I may remember you that the basis of the rules of Europe is that no country is being bailed out because it is fiscally responsible for itself. Otherwise, you would have the wrong incentives all over the place. Now, if banks are too strongly exposed to their own governments, this can hinder a market-based regime of public debt. I don't need to explain you that, namely the possibility of restructuring government bonds without jeopardizing financial stability. Now, to tackle this sovereign bank nexus, one important step is to reduce the existing incentives for banks to lend to their governments on an unhealthy scale. Easily said than done. As you see, there's actually no easy way to tackle the institutional imbalances in the euro area. If we want a feasible and if we want a durable solution, we have to get into the nitty-gritty of individual policy fields. It's not going to be that easy, not even at Columbia University, to find a solution to that problem. And let me now turn to another very fundamental challenge which I announced at the beginning that we are currently facing in the euro area and also globally, I might add, so there's a real relevance for this country too. I'm referring to the questions raised about the value added by international and transnational cooperation. Are we going to go bilateral between countries now, or are we going to stay multilateral and international and transnational? Cooperation used to be the fuel of the engine of European integration. How can you have European integration without not wanting to cooperate? That is a contradiction in itself. Today, Brexit, nationalist movements in Europe, and the resurgent protectionism are giving us as policymakers, I must say, a lot of pause for thought. Might we have put too much stock into cooperation? Were we wrong by expecting cooperation to be the fuel and the engine of future developments? Are the benefits cooperation brings, insufficient to justify its costs? So these questions are being debated now at international fora, also will be debated at the IMF, where I'm flying right after this meeting. Now, the added value of international trade is at the core of this debate. Is there value in international trade? For a long time, as long as I can remember, the utility of international trade was always undisputed, I must say. What I learned at university, that was never an issue. It was never being debated, or there was no back and forth. There was no question that international trade is healthy. And international politics, therefore, always concentrated in the past on ever more detailed arrangements and ever more detailed standards of international cooperation and international trade, and didn't call into question whether or not international trade is good or bad. It was a foregone conclusion that international trade is something everybody profits from. But all of a sudden, debates have been not about the degree of economic integration anymore, but about whether we should cooperate at all, whether it's important for countries to cooperate internationally. Now, even mercantilism, debt for centuries, I may add, has found its way back into politics, believe it or not. I think this trend is leading us down the wrong path, and it will not help us find tangible solutions. And this is why I would like to use this opportunity at Columbia University to say a little bit about international trade and international cooperation. The social and economic issues that countries across Europe and across the world are actually facing are actually not at odds with the conventional wisdom regarding international trade. But as ever, it is complicated, and let me just throw some thought on this issue. Now, what globalization statistics actually show is that economic integration does indeed raise aggregate wealth. It does not destroy aggregate wealth, but all statistics I know say that economic integration indeed raises aggregate wealth. Worldwide exports and imports have reached, as you know, roughly 60% of global GDP, and global economic integration has surged in recent decades, quite a bit. Now, at the same time, real income has grown globally and has also grown across the income spectrum since the 1980s, almost in a straight line. Now, these developments are not accidental side effects which just happen to take place. Indeed, trade theory predicts a more efficient allocation if you have international trade. This happens for quite a number of various reasons, for a variety of reasons, such as comparative advantage or economies of scale, if we all remember well from university. Now, economic integration and that is something I would like to mention at a university like Columbia, economic integration also facilitates a knowledge transfer. Now, this is something to be mentioned at a university. Knowledge transfer, bringing innovation to places that would otherwise not have benefited from these technologies otherwise. At the same time, just because trade leads to gains overall does not mean, let's don't get that wrong, there won't be some left worse off. That is not what I'm saying. I'm saying that trade is increasing wealth, but it doesn't mean that everybody is going to be better off. So there is clearly an issue of some left worse off. And this has been studied since the early days of international economics, and is not something which is totally new. Recent surveys have actually identified groups that have suffered from international trade arrangements, at least relative to their national peers. Not everybody is benefiting exactly the same way from international trade. And these effects are not proof that international trade theories have failed. Actually, I would argue that indeed they are part of the evidence that the theories which are being taught are correct and that the theories are right. Accepting trade theories therefore demands accepting that negative side effects may and actually most probably will occur. There is a broad consensus amongst internationally active politicians that those side effects need to be met with appropriate counteractive policies in order to make sure that these side effects are not as large. But beyond theoretical disputes, as we have them here at Columbia, what can actually be done about these side effects of economic integration? Because, of course, they are worrisome and they need to be studied. Jurisdictions may, in principle, wish to employ tailored social policies to target unwanted inequalities, unwanted inequalities in cases of social hardship. However, there are political economists that have challenged the compensatory menu of national politics. One important contribution in that field stems from Danny Roderick. He actually comes from Harvard, if I may mention this name in this place in the first place. And Danny has even labeled international integration as a, and I quote him, golden straitjacket that allows for increased overall wealth at the cost of fewer options for local politics. Allow me, if you will, to read out one of his quotes, and I quote him. Governments today actively compete with each other by pursuing policies that they believe will earn them market confidence and attract trade and capital inflow. And then he's quoting those policies. Tight money, small government, low taxes, flexible labor legislation, deregulation, privatization, and openness all around. End of quote. I think his observations on that matter can hardly be ignored because they're really important. So how constricting is this golden straitjacket of globalization for us is the real question we should be debating. It is there. The question is, how much is this restricting us? Do we perhaps even need to take a step back from current international integration? Do we have to stop or slow down current international integration in order to allow for a broader range of national policies? Not an easy answer to answer, I have to say, or an easy question to answer. I personally take a more optimistic approach, and I take this a more optimistic approach out of several reasons. First of all, I would argue that we should not expect protectionist policies to lead to fewer constraints for local politics. Instead, these policies reduce the size of the overall pie, if you want, which is available for distribution. Countries actually withdrawing from international cooperation will very likely see the size of their respective pies shrink rather than grow. Now, even more importantly, impediments to trade actually do not address major root causes of social imbalances. And major sources of social imbalances, I would think, are, for example, technological innovation, and the very, very important vital role of job qualification, something the university is, of course, catering to. Admittedly, we cannot fully disentangle the role of technological improvements, of innovation, from the role of international trade in explaining economic growth, or, on the other hand, widening income inequality. Of course, there is a direct link between both. However, innovation does have a major impact on the social structure of a country, be it the United States of America, be it Germany. Now, endorsing protectionist policies, if there's one thought I would like to leave with you, then it's that. Endorsing protectionist policies will not enable politicians to evade issues of social cohesion within their countries. I'm very convinced of that. Secondly, extensive participation in international trade does not preclude social benefits. In fact, the member states of the euro area, where I come from, provide social benefits that are quite competitive, so to speak. Thirdly, we should value the positive effects of international standards. International standards may help maintain a level playing field globally, and they may prevent a regulatory race to the bottom in policy fields that serve the whole of the society. So international standards are very important, and therefore I do not entirely follow Roderick's reasoning, which may bring me back a little bit being accepted by Columbia Business School, Columbia University. Still, what I see is his most important message, and his most important is that we should not artificially separate international economics from national or regional politics. We should stay on a course of international cooperation. That is something which I truly believe in. So, ladies and gentlemen, I'd like to close with regard to the rather complex challenges facing the euro area where I come from. I have certainly not presented you with a solution, and I for sure have not presented you with a solution that Mr. Mencken would have regarded as simple, clear, and wrong. At least I hope so. Instead, I've tried to show why solutions in this area have not yet been found. Let me highlight two key messages. First, regarding the two challenges that I have discussed, their complexity results from interactions between the economic and the political sphere. Solutions cannot be found merely by treating the symptoms. Instead, we need to tackle the underlying causes. And for academics, like Professor Mosser, and policymakers alike, it remains imperative to continue to study these interactions. And I would encourage students also at this university to do that because we further need to understand them. In doing so, we should not ignore issues of inequality. Inequality are very, very important and a cause for social friction. So we need to be able to understand much better what causes these inequalities. Second, now, if we are faced with complex problems, we can achieve a lot by correcting wrong beliefs. Our reality is simply complex, so we should not attempt to present it in an even oversimplified manner. And that's why I'm thankful to be invited at Columbia University, which gives me the chance of discussing a more complicated issue without oversimplifying it. Politicians and other experts are reminded of their responsibility to inform the public, even and especially on matters that are complicated, rather than on just simply oversimplifying them and then not answering them. These are all reasons not to question the entire project of international cooperation at sight of simplistic alternatives. Instead, I would argue we need to search for convincing long-term solutions. I hope there is going to be a debate. Thank you very much for paying attention to what I said. Thank you.
To start us off, though, I'm happy to introduce, for those of you who don't know him, Professor Adam Tooze. He is the Cullum Davis Professor of History here at Columbia, the Director of the European Institute. He's a scholar of contemporary and 20th century history, particularly in Europe, and most recently, particularly of finance. And a current book that I think is still a work in progress is actually about looking at the 2007-2008 financial crisis from a historical perspective. So, Adam?
Well, thank you so much for inviting me to comment on this fascinating paper. And I want to start by saying that the comments I'm going to make really should be taken in the spirit of your call for complexity and your call to avoid simple but evidently false answers. And really, I want to, in a sense, highlight more elements of complexity and more elements of dilemma and just hear what you have to say, or perhaps what you're able to say about the scale of these problems in the current moment. Because clearly, as you pointed to at the beginning of your remarks, we are in a moment. We are in a moment of unprecedented, there's a new kind of tension in transatlantic relations. There have been other tense moments. Iraq was an incredibly tense moment. 2008 in its own right was a very tense moment in transatlantic relations. This is clearly of a new quality, and it is, for me as a European and somebody who is a sort of adoptive German, a matter of no small pleasure and pride to hear representatives of the German government and of the German states stepping up and saying the kind of things that you've said today. And it's been widely reported that the German Finance Ministry and the Economics Ministry is preparing a strong and powerful rebuttal for the G20 meeting precisely on these themes. And this is essential. And it's essential that it should come from a democracy like Europe and that we don't have to rely simply on the technocratic intelligence of China as a representative, I think, of globalization, for which we must also be thankful, I think.
We have to get used to it.
We have to get used to it, and we have to respect it for its awesome accomplishments. But I do think there are a series, for me, of real dilemmas that then cut to the kind of political chase, and I'm going to formulate three of them, and they're quite sharp points, so I really meant that preliminary point correctly, that I really want to explore the dilemmas, particularly of a German central banker at this moment. So the first one is that when the Trump administration makes these ignorant and ill-informed criticisms of Germany's trade balance, stripping it out of its European context, imagining that Germany has a trade relationship with America that's separate from Europe, clearly that needs a rebuttal. But one of the risks in the rebuttal is that Germany goes the route which, early on, to name no names, came from a very high-placed position on the German side, which was to say, well, look, this is all very well, but it isn't our fault. Right? It isn't our fault because Germany doesn't set European currency policy. In fact, Europe doesn't have a currency policy. It doesn't even set European monetary policy. We just simply trade at whatever exchange rate emerges from the relationship between interest differentials between the US and Europe. It isn't our fault. Now, that's at some level obviously absolutely correct. The question, of course, is whose fault is it then? And it seems to me worrying that one particular implication that might be drawn from that is that, of course, it's the fault of the ECB. Because fundamentally, Germany has a minority voice in a central bank which is pursuing a quantitative easing policy against the trend of American policy, and this is having an effect on German exchange rates. So in this struggle, and the aggression, of course, and the shift is coming from the United States, not from the German side, but as Germany struggles with this new pressure, what kind of new tensions does this potentially create within Europe itself? As Germany attempts to deflect and to push back and to explain where the real line lies. One temptation one might have is to think that this could be part of a German campaign, which after all has also been widely reported, which is to bring an end as quickly as possible to the quantitative easing policy of the ECB, which has been unpopular in Germany since its inception, and now, after all, could be seen as one of the triggers for the American pushback on trade. So how will that American pressure play on those internal European tensions? And that then brings me to my second point, which is this issue that you raised, which is clearly one of the absolutely hot-button issues with regard to the fiscal structure, and it combines all three elements, doesn't it? And I really want to talk to you, or bring out the third element, this question of the rating and the valuation of European sovereign debt, which is obviously a matter, first of all, in the first instance, if you like, of the fiscal regulation of the Eurozone. As you brought out, it's also a matter, obviously, of banking regulation. What kind of capital weight do we attach? Do we attach greater capital weights to more risky European bonds? What implications would that have? It would certainly fix the incentive problem. But of course, the third element is that this is also an issue for current monetary policy. And one of the things, certainly on the prevailing Anglo-American interpretation of the macroeconomics of the Eurozone that took us out of the crisis phase in 2012 was the indication that the ECB would do whatever it takes. and one of the interpretations of the recovery of the Eurozone since early 15, and the fact that the Eurozone rode through the big Greek road bump of 15, was that quantitative easing was in place and was providing a backstop, and has created a de facto level playing field between the sovereign debts of the European states. So that, for me, is the third element in this. You highlighted the structural issues of fiscal policy. You highlighted the issues of bank regulation. How do we relate short-term monetary policy to that, and how do we specifically think about, as it were, the exit from the emergency regime of monetary policy that we've been in and its implications? Because take that away, as, for instance, Portugal risks with its teetering on the edge of losing its investment grade, and we could be back in crisis mode. The third element is to do with crisis, and it's to do with the way in which we talk about crisis and the way in which we think about politics in that crisis and the role of officials like yourself in relation to those politics. Because the way in which I think the mainstream, let's call it that for want of a better word, formulates the problem of the crisis right now is political, and it formulates it in terms of populism. And formulated that way, we almost depoliticize it again. There's common sense, there's what we all know is true, that globalization is good, and then there's this problem, and it's almost like a virus, and it's populism. The problem, of course, is that if we're democracies, populism is just the polite people's name for democratic parties with democratic constituencies with large bodies of voters. And so at this point, when central bankers talk about the problem of populism, they're really in a process of marginalizing, problematizing what are, as we currently accept them, legitimate political positions. Now, we may find their attitudes to racism, for instance, completely reprehensible, and we may take a moralistic position. But with regard to economic policy, I'm not sure that that's as appropriate. And it seems to me to raise absolutely fundamental questions for how officials, decision makers talk about the democratic process, because we may need to accommodate ourselves to the fact that it now structurally includes, and in the White House includes, somebody who many of us might want to term a populist. So let me make this very concrete. In 2016, in the UK, the central bank, the Bank of England, bravely and rightly, in my view, came out very clearly on one side of that argument. And it lost. And then, I think, very dramatically pivoted and said, right, now we're the Bank of England of a Brexiting country, in which case we need to up the swap lines, we need to provide liquidity, we need to cushion the consequences of what for us was a profoundly disagreeable democratic decision, and one in which we openly intervened. And so my question is, how do you, as a central banker, view that kind of dilemma? Because in effect, you're voicing a partisan position when you speak for globalization. And what is the responsibility of central bankers in dealing with the unpleasant consequences of democratic decisions? And to put it very bluntly, do we have a contingency plan for the event of Le Pen winning? Or it being very close? Because presumably, if the Bank of England stepped in, and despite its, every bit of its body presumably revolting against what it had to do, nevertheless provided the monetary cushion, in so doing it wasn't punishing democratic decision-making, it was underwriting it. And do technocratic decision-makers have a responsibility to do that too? Because in the Eurozone, we've seen other ways of proceeding, notably with Greece in the summer of 15, where the ECB, in a sense, brought the curtain down. But central banks can act differently. And with regard to the Italian referendum, for instance, Draghi made it perfectly clear there'd be bond buying before or after the referendum, regardless of the outcome. And it helped stabilize it and turned it into a political non-event. So those are the three questions. And it does seem to me they're the three of many, but they do seem to me to bring out, as you were saying, the extraordinary complexity and difficulty of the situation that we're in right now.
Thank you. Now, three very good questions. I have to say before I start that today begins the quiet period for the European Central Bank, because we have a meeting within the time frame of this quiet period. I'm not going to comment on monetary policy particularly, and nobody else will from the European Central Bank, as you would expect. Now, the question of Germany and the current account surplus, at the end, what you said is correct, because it's not our fault. We don't control we don't have a currency, we don't control it, and we believe in an independent central bank, I must say, and so the trade Germany is having is a product of its competitiveness and the competitiveness of its products rather than of us manipulating the currency, which we cannot and will not do, and whether it's right or wrong or whose fault it is of a secondary nature. Our trade imbalances are especially high outside of the euro area, outside of Europe. They're not, by far not, as high within Europe, which, by the way, is still our largest export market. So the question or not is, what can we do about it as policymakers in Germany? The way you talked about democracy in your second point, the way Germany works is that we cannot tell our corporations to export less. And we will not, by the way. It's not, it's a private sector effort, not a public effort, and this is not how this works. So we believe that as much as we learned at school and at university that if there's a division of labor that you increase overall wealth, we believe that there's a division of labor in trade that this increases wealth, and I'm particularly at this place at Columbia mentioned this transfer of knowledge being so important, because it gives access in all countries on the world, given modern communication and technology, the possibility of learning from each other. So I don't see an alternative really to that, and I hope that over time, and Germany has the G20 presidency this year, and so we have the G20 presidency at a very, very important point in time, to be honest, in order to get to an agreement and to a better understanding of what international trade does and does not do. So don't confuse, as I tried to say in my poor English, inequality with the benefits or cost of trade. These are different. They're not unrelated, but different issues and different root causes which need to be discussed differently. Your second question was about quantitative easing, something which I cannot speak about, but in very general terms. At the root of your question lies an understanding of what monetary policy actually can do. You phrased the question of what it should be doing, I would say what it can do. And there we do have some misunderstandings, which I, by the way, understand, given how much monetary policy has reacted compared to fiscal policy in the euro area. It was almost that monetary policy was the only game in town. Nobody else was there doing anything or doing much. So no wonder that over a longer period of time, this question of yours comes up. But let's don't forget that the root causes of a debt problem are in fiscal policy, not in monetary policy. They didn't incur the debt, and they did not incur the imbalances, let's say, with the real estate market and other parts of the economy. So basically, what monetary policy, let me remind you, can do is monetary policy, especially in a currency union, can buy time for fiscal policy to react. But there needs to be a link between this time which is being bought. Time must be used efficiently. And I must say that I'm not always convinced that it was used efficiently, and it could have been used better and should be used better. So the power of monetary policy should not be overestimated, because on the one hand, society, politicians want monetary policy to solve all the issues. On the other hand, they remind them that they have a mandate and should stick to their mandate. What exactly are we talking about? You cannot have the cake and eat it. And that's why we have, if we want credible monetary policy, we need to stick to a mandate, which in Europe is even a single mandate, not a dual mandate like in the United States of America, and which is a mandate of price stability, and which is a strict mandate, which brings me to your third question of populism and democracy. And let me start by commenting on last year, when the Bank of England, as you said, came out on the side of one argument. I didn't see it that way. I know that many people thought that the governor of the Bank of England positioned himself for a Remain vote. He didn't do that. That's not my understanding. What the governor did is he quoted his statistics and his empirical evidence saying that should there be a Brexit vote, the economy in Great Britain would suffer. By the way, the European Central Bank and my institution, the Bundesbank, had exactly the same data. And it is not something where he presented something which I would find manipulated or one-sided. This was the data we have. And I still believe, I am a simple thinker, that over time, no economy, and also not the British economy, in the long run can benefit from a Brexit. You know, and I would argue, not taking one side, that we are in a lose-lose situation, so that these economic effects the governor was describing will eventually kick in. But they haven't kicked in, but they will kick in, and but it depends on, you know, you have to explain to me how a real estate market can rise in a situation like that. It's, for me, who is somebody who is not focusing on short-term effects, but more on medium to long-term effects, is hard to believe. So, your question was about what should central banks do, what kind of interventions can central banks do if populism is part of democracy, which is, of course, it is. Now, there's a dilemma, but it's not that difficult to solve, because the dilemma is that central banks have to stick to their mandate. If central banks try to enlarge their mandate, you would be very right. Yeah, if you interpret your mandate now to comment on everything, then you are spot on. I once had a colleague on the board of the Bundesbank who wrote a book about immigration, which was not within our price stability mandate, I would think, and he's no longer with us. You have to stay. You have to stay in your mandate, and I recommend that, because we want credible monetary policy. Everybody wants credible monetary policy, and for that you have to stick to your mandate, and that is pretty narrowly defined. And this is why my answer to your second question was exactly the way that I said, that we, within our mandate, our power is limited. And that's why there needs to be an understanding that monetary policy is there for price stability. Here you have also a second mandate of the Federal Reserve being connected to employment, but in Europe we have only one single mandate, and as long as we stick to the mandate, we can be credible. And that's why you should never, I suggest, you should never interpret the intervention, let's say, of the governor of the Bank of England, or the governor of the European Central Bank, or the governor of the Bundesbank as having the intention to come out at a single side. We are purely debating economic matters as we see them, and we have the duty to basically stay within the parameters of our economic findings, rather than coming out on one single side. So, nevertheless, populism is worrying me, as I said earlier, and it's basically worrying me because, as you mentioned when you started your question, because it's oversimplifying things. It is very complex issues are being presented in a very simple way, without a solution or without an alternative. And that is something which I, as a policymaker, of course, need to debate, because, and that's where Columbia and all of you have a role, because if we think we can all break it down to very, very, very simple questions, I fail to see the simple questions. I rather see very, very complex and interdependent situations which need complex thinking and complex answering. Now, I know that in a world where there is a lot of populism around, for politicians to become complex and complicated is not winning lots of votes, but that's part of the job, I have to say. And you know, if you try to avoid complex questions or complex answers, that is not something which blends well into my understanding of my mandate.
So, if you have a few more minutes,
I have 5 minutes.
Okay. Why don't we open it up to a question or two from the floor? Okay, one right here in front. And could you please identify yourself and your affiliation, please?
Sorry. Can you hear me?
Yes.
Too high.
Yeah.
My name's Alice Labrie, and I'm former U.S. Department of State Foreign Service. I live here in New York, in Harlem. First, just a quick commendation, and then I'll ask my question. And my commendation is to you for your comments on international trade, because I think that international trade keeps peace between countries. Do you trade with North Korea?
I don't trade at all. It would be German,
not
German,
you, but
German
German,
companies. I have no information to what extent German companies trade with North Korea. But it would be, as long as there is no embargo, be absolutely free to them to trade or not to trade. It's an economic decision, not a political decision.
Well, in closing, if I just quickly may say, I sort of come here to elicit your help because for 5 years I have been encouraging my government to establish an embassy in North Korea for the purpose strictly of trade. And I have hopefully my new wonderful President Trump's ear in that regard. So to all of you out there, please help me. I think trade, let's make trade, not war. So thank you.
Again, this would be a little bit outside of my mandate, but I believe that trade channels are important, and to some extent it's within my mandate because foreign currencies obviously are, and foreign currencies need to be traded, and there needs to be, that's my strong belief, a free trade of currencies and not a manipulation of any currency. So in any case, we are a believer in free trade, but if there are political embargoes, we of course adhere to them.
So, one more question?
There's one more, and then we shall be.
Yeah,
Gentleman
that's
over
right.
there.
Yes.
I'm Professor Emeritus Hugo Kaufmann. I'm a graduate of Columbia University and was professor at the City University Graduate Center and directed the European Union Study Center for 20 years. So I have a few comments or questions. Number one, the central banks, or there is a general credo that we should get an inflation rate to 2%. Now, suddenly, 2%, that means raising to 2%, is a goal. The reason why the 2% came in before the euro was created was to get the inflation rates of the participating countries down to 2%, to not more than 2%. So suddenly, we had one saying that, and we should know and remember, that inflation is not something that you can fine-tune, that you can manipulate. So that there should really be a goal of price stability, because even a 2% inflation rate devalues the purchasing power of the money by 50% over a period of 36 years. So that means if you want to have the two, as you divide, anyway, by, so the other thing is, why do people not remember that part of the Great Depression of the 1930s was the raising of tariffs, the protectionism which countries introduced, and why do people not talk about that? If I raise tariffs, the other one is going to retaliate and raise tariffs too, and we all are that much worse off.
Yes.
And the last thing, which I do not understand, is there was a big debate in the late 70s and 80s in the United States that the central bank should not, I mean the Federal Reserve, should not have the dual responsibility of quote-unquote full employment, because that concept would have to be defined as well. And secondly, the domestic, because the central bank cannot control the labor effect. And in the case of France, for instance, we know that the labor laws are inimical to solving the unemployment problem. Thank Thank you very much.
No, thank you very much, Professor. Now let me go through that, but I'm not going to comment on the mandate for the Federal Reserve. Please understand, because I'm not going to intervene in other central banks' mandates, but clearly labor laws, taxes, and others are very important, not only monetary policy with regard to the question of employment. Now, regarding the inflation target of 2% or close to 2%, let me just mention that this is consumer price inflation. We're not talking about asset prices and not necessarily about a devaluation. Right now, we are having very low consumer price inflation and rather high asset price inflation. So we're looking at price stability in the context of consumer price inflation, assuming not everybody buys a house every week or sells the house every week. So the goal of the 2% inflation target basically is having a buffer between 0 and 2% to avoid going into deflationary consumer price inflationary territory. So it's not necessarily the idea of accepting a devaluation of wealth, but it's the matter of keeping prices stable in terms of consumer prices well above a deflationary scenario. And I think everybody would agree that a deflationary scenario is a pretty dangerous and value destructive scenario, which of course, being this spiral of ever increasing deflationary tendencies, postponing investments, postponing purchases because you believe it's going to be cheaper the next day, which has all the... It's very difficult to make money, by the way, in a deflationary scenario. I haven't really found a way, and hope I don't need to. Now, you also asked about, very correctly asked about the raising of the tariffs and protectionism. And that's what I also tried to speak, and I think my colleagues have a copy of my speech, which they will distribute when you leave. And if you read that part again, you will see that I fully agree with you that we all are worse off because everybody is going to react to somebody raising tariffs, and then we have a scenario where what we would call a free trade or a market economy is going to be very much impaired, and there are going to be other forces, and the state will be the one to set the prices and will know better than the market what's the right prices for which product, which I am not necessarily a believer in. So I fully align myself with your second question. So thank you very much.
Thank you very much. We appreciate you coming and giving such interesting remarks. I hope your trip to Washington is successful.
Thank you very much. All the best.